Good day, everyone. Thank you indeed for joining us today for this webinar on the transformative growth opportunities. I'm Neha Anna Thomas. I'm an Associate Director with the Economic Analytics practice at Frost Sullivan, which is responsible for producing economic thought leadership, and we also author Frost Sullivan's annual Global Economic Outlook. So it is at this juncture that we wanted to give you a little bit more of a peek into what's expected for the 2025 Global Economic Outlook, particularly at this juncture, as we know, where a lot of things are changing with the new Trump administration in the US. So without further ado, I'd also like to introduce you to my colleagues today who will be joining me in today's presentation. I have with me Rituparna, who is an industry principal with our economic analytics practice, and also introduce you to Nikita. So to give you a quick overview of what you can expect over the next couple of minutes, so we will be delving into the key macroeconomic highlights for 2024 and set the stage before we delve into key growth expectations for 2025. And we've outlined these growth expectations, particularly in the context of different visioning scenarios, because as we know, we're seeing a lot of tariff changes, a lot of policy changes. So it is important in the strategic planning process to evaluate growth under different scenarios. You will be taken through major country GDP forecasts. And then we're going to delve, of course, into what Trumponomics 2.0 particularly means for the global economy and how things are going to shift under some of the new policy announcements that we're seeing with regards to trade. So I'll hand it over to Ritu now to take us through the global economic performance of 2024.
Thank you. Thank you so much, Neha. And thank you everyone for joining today's think tank. So let's take a quick recap at some of the key highlights from 2024 global economy. So just to put some context to this, so we, as a part of Frost & Sullivan's economic analytics thought leadership, we track macroeconomic indicators on a regular basis, based on any additional information received throughout the year. We closely monitor implications of any fresh economic event that might pan out. And we also engage into reforecasting our predictions based on that, and that we do on a pretty much on a regular basis. So in this particular slide, we wanted to provide a quick summary of how our 2024 reforecasts panned out. So we have here 2024 January forecast as well as December estimate. So just to show you a quick glance into how the economic prediction might have moved over the last year. And so what you're seeing is, so if you look at the middle columns, we have placed our initial predictions made back in Jan 2024, and the last column provides the final estimation done in December 2024. So looking at the GDP growth performance for 2024, growth ended at quite a robust 3.2%. So that's quite a good performance and much better than what we had originally expected. And the US in particular actually defied expectations and did way better than expected. But then if you look at other major economies, especially China, then Germany, so they saw some sort of a slower growth. Now, on the inflation front, it has also started to trend downward. So that's a good news, and it would definitely give some support to consumer spending. Now, CPI, which is consumer price inflation, that averaged at around 5.7% last year. And then when we look at the monetary policy, central banks have already begun with rate cuts across major economies. And with regards to the currencies, I think what we saw last year was a very strong dollar, which I think also contributed to a high trade deficit coming in from the US. And in terms of the oil prices, in 2024, obviously the price of Brent crude I think was hovering at around 80 to $81 per barrel, which was pretty much the same as in 2023. And OPEC Plus, I think, made a lot of adjustments in terms of production cuts, which helped balance things out and keep the price levels stable. So these are some of the key highlights of 2024 global economic performance. As we are entering in 2025, the narrative is definitely about uncertainties and unfolding in large pockets, and how these changes are kind of significantly impacting majority of the macroeconomic fundamentals such as growth, inflation, trade flow, expenses, and so on. So in this particular slide, we are displaying the GDP growth projections on the right hand side. So we have these three charts drawn out. The first one is for the global economy, the global growth. Then we have the GDP growth numbers for the advanced economy, and the bottom one is for the emerging economy. And on the left, we have drawn out specific scenarios. So we have a baseline scenario, and then in addition to that, we have one optimistic scenario and one pessimistic scenario drawn out. And of course, the way the global economy is panning out is extremely volatile. New policies are being implemented as we speak. So scenario planning is something that has become extremely crucial. So, if you could turn your attention to the left-hand side of the slide, so you'll see that as a part of the baseline. So how do we define these scenarios? The baseline scenario, for example. So baseline scenario is drawn based on what is most likely. Like a lot of it is based on what's most indicative from the current policies and from the current market forces, etc. And pessimistic and optimistic are cases created based on, let's say, other risks or other opportunity elements that might pan out as time progresses in 2025. So, for example, baseline takes into account, when it comes to, let's say, baseline and the tariff, right? The baseline takes into account 10% tariff on China coming in from the Trump administration, which is already implemented, we know. And it also take the baseline. As a part of the baseline, we have also taken into consideration 25% tariff on slated for Canada and Mexico, even though we know it's delayed by a month or so. But we would like to believe that it's a base case, particularly when it comes to the Mexican tariff. And obviously, that is also kind of when you look at the trade deficit that the US has with Mexico. So we definitely see Mexican tariff and as well as the Canadian tariff to be a part of the base case. And then we have also considered the recently announced 25% tariff on steel and aluminium, right? So that's how we have defined the base case, the larger part of the base case. And then obviously there are other nuances, for example, immigration, right? So immigration, we have only taken into consideration only a limited amount of mass deportation, right? Happening from the US, only a limited mass deportation as a part of the base case. However, any blanket tariff, let's say on Europe or on rest of the world, have not been added to the baseline because we believe that the impact of these tariffs that have already been implemented, such as on China, on let's say on steel, on aluminum, on Mexico, so the impact of these tariffs will first be evaluated by the policymakers, by the US, before any new tariff measures that are being implemented. So basically, because see, if you look at the US's primary agenda is to control inflation, and tariffs would most definitely flare up inflation, at least in the short term. So, we have seen that, I think, starting last year, Q4 itself, inflation started to flare up. And tomorrow is when the US's January inflation data is going to be released. So we are expecting an uptick in the inflation levels in January itself. So hence, any new tariff seems to be, a part of the conservative scenario. So what we are saying is that any new tariff over and above the ones that are already implemented is a part of conservative scenario. So that's how we have played around with the defining all these scenarios. Now so that's about the baseline, and then when you look at baseline and pessimistic, so now when you look at the optimistic scenario, so that seems to be most unlikely at this stage. However, this is also something we are closely monitoring, and we're not really ruling out the possibility of an early rollback of tariffs, or let's say a pause given to the tariffs, for example. So in an event where, let's say, there is a sudden inflation rise, or there's a very high inflation happening, or there is an economic chaos globally felt, then in that kind of a scenario, the tariff war could be rolled back. And that is when then it kind of would form an optimistic scenario when the GDP would basically get a solid momentum. So that's how we are defining all these scenarios. And under a base case, if you can turn your attention now to the charts, so under a base case scenario, we expect global GDP growth to slightly come down to 3.1 levels. So from 3.2 is what we saw last year. So we are saying 3.1 as a base case. We are not really expecting the baseline GDP to be drastically lower than 2024 levels, because the policy shifts are creating growth downturn in certain pockets for sure. For example, in Americas, in Mexico, China, they're definitely creating growth downturn. However, if you look at some of the other economies, let's say in South Asia or Southeast Asia, Australia, Middle East, these are showing great resilience, and they would definitely keep the global GDP growth stay afloat. So that's what we are seeing under a base case scenario. And under a pessimistic scenario, we are saying the global GDP could potentially slide below 2%, a level that's lowest post-COVID, and optimistic somewhere around 4%. So this is what the global scenario is, what we are seeing. For the advanced economy, I think baseline 1.7% growth for this year, which is a slight downward again from 2024. A pessimistic could push some of the, under a pessimistic scenario only, could push some of the advanced economies, particularly in Europe, near recessionary conditions. Then if you look at the emerging markets, I think same rule applies. Growth would tend slightly downward. However, economies, particularly in South Asia, Southeast Asia, Gulf countries, they would give some support. So that's a quick picture and an overview of the scenario analysis. And then if we move to the next slide, we would like to provide you with some of the talking about some of the countries, like individual country growth outlook and how they are panning out for this year. So this slide is, like a weather report, where we quickly try to give you a glance through the GDP growth expectations for key countries in the world. And the numbers that you're seeing over here for these countries, so these are all based on baseline expectations. So now if you look at some of these countries, so most of the countries that you're seeing, so we are expecting a growth slowdown for most of the countries from their 2024 levels. I think only for Saudi Arabia and the UAE, we expect stronger growth from last year, as we expect, that is based on some oil sector recovery. And we also expect Japan to rebound in this year, driven by rising wages and some sort of a stronger demand coming from Japan. So that's what we are seeing. And now in terms of the US growth, obviously, if you look at the US, even though we are expecting the US economy to moderately slide to 2.2% in 2025 from 2.8 last year, we would like to believe that, there are market forces which is quite positive, such as, there is still strong consumer spending, there is low unemployment, inflation is coming down, there is monetary policy easing, also the government is talking about boosting the energy sector. So all these would definitely work in favor of the economy, but there are definitely downside risk elements coming, particularly from the retaliatory tariffs. And then there is definitely a fear of mass deportation, right? That would create some sort of a labor shortage. But net 2.2% is what we expect for the US economy. And then now if we turn our attention to, let's say, Europe, Euro area, or some of the countries over there. So outlook for 2025 indicates, I think, modest growth. And there are challenges exist. And if you look particularly at Germany, Germany faces a critical year in 2025, and obviously it had a very disappointing 2024 due to declining export, stagnating private consumption. We expect a slight recovery for Germany, supported by falling interest rate and falling inflation. However, exports, the most important parameter for the economy, that hinge on uh, global trade policies and how the tariffs on steel and aluminum pans out, because Germany is home to some of the world's most advanced steel manufacturers. So that's what we are expecting for Germany. So now, if you turn your attention to Asia, so for a quick roundup on China and India, because these two economies are quite prominently driving global GDP growth over the past many years. And if you look at China, so for 2025, the growth target looks, I would say, modest at 4.1%. This is quite modest given China. We have seen how historically it has grown in the past. So we would like to believe that this is definitely due to weak demand as well as US tariffs, the fear of US tariffs. However, fiscal stimulus should definitely provide some support to the US economy. Now, given all of that and the uncertainty, we definitely expect the Chinese economy to hover somewhere around 4 to 4.1%. India, again, it's a resilient economy, and I don't foresee, we do not really foresee any major risk element that stands out for the economy. The country's growth to definitely remain resilient. There has been consumption boost that has been given in the recent budget. Then central banks are cutting, repo rate and so on. So that is giving boost to the GDP, etc. So we are saying for India 6.5% to be this year's GDP growth forecast. So yeah, so that's a quick roundup on the country growth cards. And now let's move to our next slide, which is about, yeah, very interestingly. So this is where we carefully analyze President Trump's policies and their implications. So what we have done is, in this particular slide, we have listed potential measures that the Trump administration is likely to implement or have implemented. So not all of them are definitely expected in this year, in 2025. So what we have done is, on the vertical axis, we have a likelihood meter. So we have tried to map which of the measures are absolutely certain, which ones are slightly uncertain or moderately certain, etc. And on the horizontal axis, we have mapped the timeline for implementation. So trying to understand whether a measure is coming in this year or for next year, etc. So we have done it for the different elements of the policies. So we've done it. So we've basically bucketed all of them into three boxes: tax and tariff, immigration, and then foreign policies. So looking at from a tariff point of view, I think most certain, we have already discussed, most certain is the China tariff, which is already implemented, and the steel and aluminum tariffs are already implemented. And then there is proposed 25% tariffs on Mexico, Canada. So that is also something that seems to be most certain as well. Now, for European Union, we do not really see, or for rest of the world or any other sort of blanket tariff, we do not really see to be a part of the baseline. And then there is also a possibility, particularly for the European Union, seeking early engagement with the US, in order to address these planned tariffs, to kind of prevent measures that could disrupt trade and investment. There is also a possibility that EU prepares themselves for retaliation. We have already seen China retaliating with tariffs. There is also a possibility, in response to the new steel and aluminum tariff, you would also want to retaliate with some sort of a tariff. So there are uncertain elements that are there. Now, if you look at the other elements, for example, the immigration, for example, and the mass deportation measures, we expect a limited and a gradual and a more, I would say, a spread out measure for the baseline when it comes to mass deportation of the undocumented immigrants. Now, in case there is a stricter, or let's say a rapid deportation happens, that would definitely create not only a sudden labor shortage in the US, but that would also create a sudden labor supply glut in the rest of the world. So that is also something that we need to closely monitor. I think this is what we want to expect happening out of President Trump's policies.
We are going back and segueing into industry implications, particularly from the Trump 2.0 tariffs. Over to you, Nikita.
Thank you, Neha. Thank you, Ritu. So before I delve into the impacts, I just want to quickly explain the chart. The x-axis moves from positive to negative, and it shows the nature of the global economic impact. And the y-axis moves from low to high, and it shows the degree of the economic impact. Our assumptions for the baseline and pessimistic scenario are, for the baseline, we are going with 25% tariffs on Canada and Mexico, additional 10% tariffs on China, and also including the recent metal tariffs levied just yesterday. And in the pessimistic case, we are assuming that the US will go for auto tariffs ranging from 10 to 20% on the rest of the world. So the global automotive sector is really going to feel the heat from the US tariffs, especially with the 25% blanket tariffs on steel and aluminum. This is likely going to push product prices up significantly within the US and, as a result, dampen demand. Now, in the pessimistic scenario, if the US decides to go ahead with industry-specific or reciprocal tariffs against, say, the European Union, it's going to get even tougher. Now, not only will inflationary pressures exacerbate, but the EU will most certainly retaliate. The EU auto markets in particular could be an even worse spot with these targeted measures. Countries like Germany, Italy, Spain, which rely heavily on US exports demand, would be hit the hardest. But it's not all bad news, if you ask me. There are still opportunities, especially if firms adjust their near-term strategies to align with megatrends transforming global trade. So, for instance, in short term, ASEAN and India are going to stay attractive, especially with China plus one trends, thanks to their cost competitiveness. So, as the audience just highlighted, as well as Neha and Ritu spoke, opportunities still are ongoing in terms of friendshoring and nearshoring. Looking further ahead, I want to emphasize that the ongoing trade tensions and price pressures that they bring will lead to the rise of regional cost-effective manufacturing hubs. So, for example, within Europe, countries like Poland, Czechia could become the key go-to manufacturing destinations. So that's on the auto sector. Moving on, let's shift gears. Let's talk about semiconductors. So here's what we are assuming for semiconductors. Baseline, we are looking at targeted tariffs on chip imports from Taiwan only. On the pessimistic side, we are talking about blanket tariffs, let's say 10% or more on all semiconductor imports. So the US has its sights set on boosting domestic chip manufacturing, and the main focus is on Asian heavyweights like Taiwan, hence our base case. The goal here is to bring chip production lines back to the US. Now, putting import restrictions on Taiwan does pose some near-term risks for the US semiconductor industry, mainly because of its reliance on Taiwan for tech expertise. However, if the US decides to slap blanket tariffs, our pessimistic case at this moment, things could get tricky. In the worst case scenario, we could see huge inflationary impact in the US, especially for consumers who might face double-digit increases in the electronics prices. This would have a ripple effect globally, considering the sheer size of the US consumer markets. Alternatively, I also want to draw your attention to the export side. US AI chip export bans, to be very specific. The previous administration's export bans on chips are still in play. Trump administration continues to maintain it. These restrictions are likely to have a sizable near-term impact on Europe, especially with the region's ambitions in AI, given its dependency on US for the AI chips. While these export controls might benefit US AI firms and drive their competitiveness, firms globally which are trying to make strides in this space will face some near-term hurdles. That said, within the baseline, even with tariffs on Taiwan's chips, we will see friendshoring opportunities continuing in Asian geographies. The assembly, testing, and packaging hotspots such as India, ASEAN, countries like Thailand and Malaysia within ASEAN, they will continue to remain attractive because of their sheer scale and cost competitiveness, especially for labor intensive production processes. So, over the next couple of years, the impact of these US tariffs will likely remain muted for these geographies. Yeah, over to you, Neha.
So we're just going to segue shortly into some of the summary outcomes, especially the high frequency indicators. What does this mean in terms of GDP, inflation, and the like? So I'm calling you back, Ritu. I'm sure our audience would like a summary view of hard data and what that means for 2025.
Yeah, I know. So I won't spend too much time on that, but just to provide our audience what these are and just an insight into reforecasts. That's quite interesting because see, just doing one round of prediction analysis is not the end of the story, is not what we want to do, because see, there are fresh events that are happening as we speak. And there are 10 more months to go into 2025. So there is every merit in considering our numbers as initial prediction for this year, and we will have to continue to revisit them on a periodic basis. So just wanted to give you a quick, understanding. So in addition to the baseline predictions that we displayed earlier in the deck, so remember the baseline prediction, right? For global GDP, for example, 3.1% for based on our February forecast or prediction. So we wanted to provide an indication here in this slide. We wanted to provide you an indication of where the reforecasts might trend towards in case we have to revise our current baseline prediction, mainly induced by the policies by President Trump. So when we look at the GDP growth, we want to weigh the uncertainty a bit more and would like to believe that, okay, baseline GDP growth, which is 3.1%, that is done in as of February 2025. So as the year progresses, that could start to trend below 3.1. That could start to trend closer to 3 or even slightly lower than 3 is what we expect. The reforecast might just start to trend below the baseline as the year progresses. And if we look at inflation, that's a slightly tricky area because, tariff could easily spike up in inflation in the short term. Hence, any new tariff over and above the ones that are already implemented and announced, they would definitely spike up inflation even more. And that would basically pull the inflation closer to 5% or even more than that. So basically, any reforecast with regards to inflation, we would like to believe that it would probably trend upward from our February predictions. But then again, why I say inflation is a tricky area, because again, US wants to boost oil production, right? So that may push prices down a bit. And then there is OPEC Plus who would want to stabilize prices through their production cuts. So this is what I wanted to quickly talk about in this particular session, to give you an understanding of what we typically do on a day-to-day basis, just a key insight into that. Hand this back to Neha.
So we are continuing to monitor these data and forecasts as the policy announcements come out, and continuing to update these figures as we progress through the year. What does Trump 2.0 mean for the global economy? In summary, you'll see some of the risks captured towards the upper quadrant of the chart in the red bubbles. In terms of these are quite obvious in the sense that with a lot of the trade wars and the tariff wars, you are going to be seeing significantly weakened external demand, and that's going to slow down exports globally, particularly hard hitting more export dependent economies, whether you're talking about a Germany or whether you're talking about a Japan. We could see more pronounced slowdown in these economies. So you'll see a lot of the risks, like we alluded to earlier, capture the higher frequency data, like exports, inflation, growth that we're referring to. So tariff wars, the trade wars, without a doubt, will have negative repercussions on these higher frequency macroeconomic indicators. We will see a growth slowdown happening in some parts of the world. As you've seen from our numbers, we've already started to revise these down just a little bit, not too much just as yet, and tariff-driven inflation, which could sort of put a lot of the planned central bank rate cuts on delays. So this is what we expect over the next couple of months in terms of risks. But at the same time, as we would know, anytime there are major disruptions in policies or geopolitical shocks, these disruptions also give rise to new opportunities, uh, new megatrends, a new global order in the sense that the way business is done and the like. And that's some of these growth opportunities that we've captured, which we've earlier mentioned are a little bit more long term. So, for example, if you look at the second one, we see some new emerging manufacturing destinations emerging when you have these tariff wars and when you see supply and production being deflected from one country to another. So, for example, the last round of US-China trade wars, we saw the rise of China plus one strategies, which only strengthened during COVID and the Russia war, whereby manufacturers sort of maintain their presence in China because it's obviously an established manufacturing powerhouse, but at the same time started to sort of deflect and diversify into, say, a Vietnam or into an India in order to secure their supply chains and embed some resilience into their production strategies. So we do sort of see the same thing happening this time. We do believe it could be a Mexico plus one supply chain strategy, particularly if those 25% blanket tariffs are imposed on Mexico. We do see a lot of the diversification in supply chains giving impetus, particularly to the regionalization of trade and perhaps even new trade agreements. And particularly when we're talking about clean energy supply chains, uh, we see two leading producers, US and China, engaged in trade wars. And at the same time, there's a lot of clean energy policy unpredictability coming out of the US. So a lot of these clean energy value chains, particularly whether we're talking about electric vehicles, the battery supply chain, rare earths, and the like, can be deflected into other countries that are actively promoting clean energies, which are a little bit more insulated from the trade wars and where there's a lot of policy support going into clean energy supply chains. So in summary, yes, there's going to be a little bit of a growth slowdown, but I would hold my breath. For example, like Ritu had mentioned, resilience was the key word of the global economy in 2024. We had forecast 2.6 at the start of the year to begin with, but performance outstripped expectations and the global economy closed in at 3%. So resilience being the key word, I do believe that the global economy will still hold strong, which is why we're not drastically lowering our forecast just as yet. And while there are going to be a lot of short-term disruptions, it's the same time that there are going to be new growth opportunities, new supply chain patterns created, especially for companies that sort of identify those early mover advantages, are on the watch out for new suppliers, are on the watch out for new business partners, and successfully sort of embed themselves in this new global trade order. So that brings us to the end of our slides. So just as an overview, a lot of what you've heard and read today, we have captured in a more detailed analysis of our global economic outlook, captured in the top 10 growth opportunities in the global economy, which is published on our Frost portal. And we also have an upcoming detailed thought leadership piece on the Trump 2.0 policy scenario and associated risks and opportunities. So if you'd like to learn how you'd perhaps want to access some of this analysis or even just get in touch with us for a more detailed discussion, we'd love to hear from you. Do write in to me.